Macroeconomics functions as a mechanical plumbing system of capital flows. When internal pressure reaches a threshold, the structure fractures, revealing exactly how capital is forced to route through the economy. This chart tracks the yield curve against GDP and the S&P 500. The curve hit its deepest inversion in decades, yet GDP expanded and equities reached record highs. Typically, inverted curves signal recession. Here, the traditional link between yield inversion and economic contraction failed. This occurred as the Federal Reserve, led by Jerome Powell, aggressively hiked rates to cool the economy. They were explicitly attempting to trigger demand destruction to bring down inflation. These macro indicators are not timing tools for traders. They are the output of a system defined by capital flows, structural constraints, and institutional arbitrage. When the engine keeps running despite a central bank standing on the brakes, it indicates that capital has found a way to bypass the traditional monetary sensors. To find a source of this resilience, we have to look at the supercore, inflation in services, excluding shelter. This is the primary constraint on Federal Reserve policy. Shelter costs are removed because they rely on long-term rental contracts, creating a statistical lag of 6 to 12 months. What remains in the supercore is a real-time feedback loop. Higher inflation expectations lead to rising wage demands, which businesses then pass through as higher service costs. This creates localized wage rigidity. Because service sectors like healthcare or hospitality are labor-intensive, businesses cannot easily lower nominal wages when demand slows without risking mass resignations or violating labor agreements. This is compounded by Baumel's cost disease. Unlike manufacturing, which uses technology to rapidly increase output per hour, service sectors cannot easily automate human interaction. As wages rise across the economy, service providers must raise prices just to retain staff, even if their productivity remains stagnant. These services are also non-tradable. You cannot import a cheaper local restaurant meal or a cheaper daycare service from overseas to offset domestic price hikes. When this service sector inflation loop becomes entrenched, the purchasing power of the currency begins to erode, regardless of the unemployment rate. This forces the Federal Reserve to prioritize price stability, even if it requires engineering a systemic recession to break the cycle. The Federal Reserve attempts to break this cycle through a dual-track tightening process. Track 1 is quantitative tightening, which physically removes excess reserves from the banking system to limit lending capacity. Track 2 is raising the interest on reserve balances. By paying banks a high return to keep their cash at the Fed, the central bank raises the hurdle rate for any potential private sector loan. This usually chokes off spending, but the 2020 and 2021 zero-interest period changed the math. Corporations and households locked in long-term debt at rates below 3%. When the Fed hiked rates to 5.5%, these borrowers were shielded. The interest rate channel was effectively severed. This shield created a net interest income anomaly. Entities with 3% debt could park their cash in money market funds, yielding 5.5%. The Fed's tightening cycle actually increased the net wealth of these borrowers. Meanwhile, historic levels of government deficit spending and a corporate culture of labor hoarding further neutralized the Fed's attempts to cool the labor market. The tightening cycle became a severed pipeline. High rates inflicted damage on new credit creation, but the vast majority of the existing economy remained insulated from the shock. This insulation creates a contradiction in the bond market. Institutional capital continues to buy 30-year bonds at 4%, even while short-term rates offer over 5%. A long-term interest rate is a probability-weighted expectation of where short-term rates will be over several decades, plus a premium for the risk of time. Institutions buy the lower-yielding long bond to manage reinvestment risk. If the economy eventually slows and the Fed cuts rates to 2%, an investor with short-term paper is forced to reinvest at that new, lower rate. The 30-year bond allows an institution to lock in its cash flow floor today. The primary goal, however, is capital gains. Duration measures how much a bond's price moves when yields change. Because a 30-year bond has high duration, a drop in market rates translates into a massive spike in the bond's trading price. Smart money buys long-duration bonds as a leveraged bet on a macroeconomic contraction. They are trading current yield for the potential of 30% capital gains when the central bank is forced to cut. This leads to another misunderstanding, the idea that the U.S. Treasury decides what interest it pays at auction. In reality, the Treasury is a price taker. The transmission from the Fed to the bond market follows a sequential necessity. Step 1 begins when the Federal Reserve cuts the short-end rate, lowering the base cost of capital. Step 2, capital instantly floods the secondary market to buy existing bonds that still carry older 5% coupons. Step 3, this surge in demand against a fixed supply of bonds pushes the trading price up. To get that 5% yield, buyers bid the price of the bond from $100 up toward $117. Step 4, the yield to maturity recalculates. An investor paying $117 today will only receive $100 back at maturity. This capital loss offsets the high coupon, bringing the actual yield down to 3%, exactly matching the new market baseline. When the Treasury holds its next auction for new debt, they must match these secondary market prices. If they offer a yield lower than what's available in the secondary market, the auction will fail. Nor can banks collude to demand higher yields. Because these auctions are a prisoner's dilemma, if one institution tries to hold out for a higher rate, a competitor will bid lower just to secure the bonds and flip them for an immediate arbitrage profit in the secondary market. This secondary market yield becomes the mandatory benchmark for all subsequent asset pricing. These fixed income mechanics dictate the environment for equity valuations. In a discounted cash flow model, long-term bond yields are a core component of the discount rate. When macro conditions keep yields high, the denominator in this formula expands, mathematically compressing the final valuation. This acts as a ceiling for high-growth tech and semiconductor stocks, regardless of their individual earnings. This gravity also controls the options market. In the Black-Scholes pricing model, the risk-free rate and implied volatility are the primary inputs for calculating an options premium. When the yield curve begins to shift from inverted to steepening, it signals that the central bank is responding to underlying economic damage. This transition structurally spikes implied volatility across the market. For an investor, a stable macro environment favors collecting premium through short puts. However, when the yield curve starts to steepen, macro fragility increases. This is the window where tail risk hedging becomes mandatory. Macro logic allows for cross-cycle defensive shifting, moving from pure equity exposure into hedged alternatives before a recession triggers the simultaneous collapse of corporate earnings and valuation multiples. Fundamental analysis identifies the right asset to buy, but macroeconomic gravity dictates the level of systemic risk a portfolio can withstand.